Imagine growing your revenue by, I don't know, 684% in a single quarter. You've got Microsoft and NVIDIA handing you literally billions in contracts and equity, and your reward is that Michael Burry is aggressively betting against your survival.
Yeah, it's wild. It's the defining paradox in the market right now, really.
It really is. Welcome to today's deep dive. It is August 12th, 2026, and we are unpacking NBIS Group, ticker symbol NBIS. And whether you're actively modeling out this massive AI infrastructure build-out or you're just trying to make sense of the current Wall Street battlegrounds, NBIS is the ultimate case study.
Absolutely. It is the perfect example of this tension between staggering top-line growth and just, well, massive capital burn.
Right, because you are looking at a company existing in two completely contradictory realities at the exact same time.
Exactly. I mean, on one hand, they possess the kind of commercial backing that most companies could only ever dream of. But on the other hand, the financial physics required to execute on that backing are so extreme that it's frankly breaking traditional valuation models.
Breaking them completely, which is exactly why we need to just tear into these numbers, starting with that Q1 2026 earnings report. Because the top-line metrics are objectively staggering.
Oh, they're off the charts.
Yeah, NBIS posted $399 million in revenue, which obviously beat consensus and represents that 684% year-over-year growth we just mentioned.
And if you isolate just their AI cloud revenue, that segment actually surged 841%.
841%, that's just bonkers. We're looking at a company that reached an annual run rate revenue, an ARR, of $1.92 billion in Q1, and management is guiding to exit 2026 with an ARR between $7 and $9 billion.
Right, which is a scaling trajectory that almost defies historical precedent. I mean, taking a run rate from roughly $2 billion to $8 or $9 billion in a span of 3 quarters, that requires an operational tempo that leaves literally zero room for error.
Zero.
And what's fascinating here is the actual composition of that revenue. Like, this isn't some speculative software as a service growth built on a, fragmented customer base that might just churn out in a recession.
Yeah, it's not small businesses canceling their subscriptions.
Exactly. The backlog is institutional grade.
Totally. Because we are talking about a $17 billion multi-year agreement locked in with Microsoft, and then another deal with Meta that's structured to be worth up to $27 billion.
Huge numbers.
Just massive. And to top it all off, you have NVIDIA injecting a $2 billion direct equity investment into NBIS. So if I'm looking at this from a distance, I see the 3 most powerful balance sheets in the entire global AI ecosystem actively subsidizing this growth.
Right. They aren't just customers at this point.
Exactly. They're stakeholders. They're ensuring NBIS has the capital to deploy the hardware. So my question to you is, why is this a battleground stock? Like, why is the short interest so high if the biggest players on Earth are throwing billions at them?
Well, it comes down to the sheer physical cost of fulfilling a $44 billion backlog. It's dragging their balance sheet into a black hole.
A black hole. That's a strong way to put it.
But it's true. I mean, in that same Q1 report where they posted nearly $400 million in revenue, they also posted an adjusted net loss of $83.6 million, which actually widened by 20% year over year.
Ouch. So they're making way more money but losing way more at the same time.
Exactly. But honestly, that operating loss is just a surface scratch. The true existential threat to the thesis lies in their 2026 CapEx guidance. Management just raised their capital expenditure guidance to an astronomical $20 to $25 billion.
Wait, $25 billion in a single calendar year?
In a single year, yes.
Okay, let's unpack this for a second, because that is spending $25 billion in 1 year to service a hyperscaler backlog. Sounds like a logistical nightmare. But from a purely financial perspective, I mean, if they have $44 billion in contracted revenue from AAA-rated tech giants, why is the market punishing them so hard for the CapEx?
You'd think they'd be fine, right?
Right. Like, can't they just lever up, use those ironclad contracts as collateral, and finance the build-out without destroying the equity?
Well, you would think so, but it's not that simple when your current operations are bleeding cash. You see, they posted an adjusted EBITDA loss of $53.7 million in Q1. And debt markets, they are highly, highly sensitive to negative EBITDA, even if you have massive contracted backlogs.
Because the backlog doesn't pay the bills today.
Precisely. A contract with Microsoft guarantees future revenue, sure, but it doesn't pay the concrete pours, it doesn't pay the HVAC suppliers, or cover the land acquisition costs today.
That makes sense.
Yeah, and Morningstar recently highlighted this exact disconnect. They assigned NBIS a no economic moat rating, and they explicitly warned that the company is likely going to need to raise billions in equity in the near term just to bridge the gap between their current cash position and that $25 billion capex requirement.
Wow, okay. Which puts the massive dilution threat front and center for anyone holding the stock.
Absolutely.
I mean, if management has to hit the secondary market and raise $5 or $10 billion in equity to fund these data centers, the current shareholders are just going to get crushed.
Obliterated. Yeah.
And that brings us to the sentiment, which frankly has turned incredibly toxic. I mean, here's where it gets really interesting. Short interest currently sits at a massive 24% of the float.
Which is huge.
It's massive. That represents roughly 61 million shares betting against the company. And it's not just, retail shorts playing around. Reports indicate Michael Burry has taken a bearish position.
A big short himself.
Exactly. When Burry and 24% of the float are on the exact same side of a dilution play, it usually signals that the market believes the debt markets are just totally close to NBIS.
Yeah, it absolutely signals a lack of faith in the management team's ability to secure non-dilutive financing. And if you look at the insider flow over the last 90 days, the executives inside the building aren't exactly instilling confidence either.
What are the insiders doing?
Well, we've seen 41 insider sells against only one single insider buy.
Oh, wow.
Yeah, resulting in a net outflow of over 145,000 shares. And, when the people modeling the cap requirements internally are consistently selling into the rally, the market definitely pays attention.
I bet. But, I want to push back on the idea that the institutional money is uniformly running for the exits, because that's not entirely true, is it?
No, it's not.
Because Leopold Aschenbrenner's fund, Situational Awareness, just took a 5.6% stake in NBIS. And Aschenbrenner is, he's deeply embedded in the AI macro thesis.
Oh, well, he's a true believer in the super cycle.
Right. So clearly his fund looks at that $44 billion backlog and the NVIDIA backing and concludes that the capex hurdle is manageable, or at least that the market is severely overestimating the dilution risk.
And that's a really crucial counterweight. Aschenbrenner's position suggests a thesis that the ultimate terminal value of holding the physical infrastructure for Meta and Microsoft, it far outweighs the near-term margin compression.
Yeah, play the long game.
Exactly. But even if you assume the funding gap gets solved cleanly, say that you get the debt, you still have to contend with the execution risk and the competitive landscape, which is really where Morningstar's no economic moat argument gets its teeth.
Because they aren't the only ones building these data centers.
Right. BNP Paribas actually just published a note favoring NBIS's main competitor, CoreWeave, which is currently sitting at around a $48 billion valuation.
And BNP specifically cited execution risk as the differentiator there, which makes a lot of sense. I mean, CoreWeave has been aggressively locking up power agreements and deploying clusters for a while now. But what exactly is the moat problem for NBIS? Is it just that CoreWeave is faster at deploying the hardware, or is there some sort of structural flaw in NBIS's business model?
Well, if we connect this to the bigger picture, the structural flaw is concentration risk, combined with a real threat of vertical integration by their own clients.
Okay, break that down for me.
Sure, NBIS is heavily reliant on Meta. Meta accounts for up to $27 billion of that $44 billion backlog. But there are these highly credible reports circulating right now that Meta is exploring ways to rent out its own excess AI compute capacity to third-party developers.
Oh, wow. So effectively the AWS origin story all over again.
Exactly.
Like Amazon built internal infrastructure for their retail operations, realized they had all this excess server capacity, and just started renting it out. And that eventually became AWS, the most profitable part of their entire business. So you're saying Meta might turn their internal AI compute clusters into a commercial cloud offering?
Precisely. And think about what that means. If Meta successfully virtualizes their excess compute and brings it to market, NBIS's largest customer instantly morphs into a direct, heavily capitalized competitor.
That's a nightmare scenario.
It is. Meta wouldn't need to lease as much capacity from NBIS, and they would be aggressively competing for the exact same Tier 2 and Tier 3 AI developers that NBIS desperately needs to eventually diversify its revenue stream away from the hyperscalers. So it's a dual threat to the business model.
Which perfectly explains why the stock chart looks like an absolute battlefield lately. Let's look at the price action.
Yeah, let's get into the technicals.
So year to date, the stock is still up roughly 130%, trading around $193.23. But that year-to-date performance really masks the brutal 35% correction they are currently in.
Right, because they fell from that June 22nd high of almost $300.
Yeah, $299.86 to be exact. And right now, it's trapped in this sort of technical no man's land. It's trading below the 50-day simple moving average of 226, but it's still finding support above the 200-day moving average at 162.
So the multi-month momentum has definitively broken. The stock is essentially just consolidating while the market waits to see if the fundamental thesis holds up under the weight of this massive CapEx cycle.
Right. But we should point out, the breakdown wasn't just a slow, methodical bleed.
No, not at all.
We saw a violent rejection just last week on August 6th, when the stock dropped between 10.5 and 13.3% in a single session. And here is where the rubber really meets the road on that execution risk that BNP Paribas was talking about. Because that double-digit drop, it wasn't triggered by a macro sell-off. It wasn't triggered by a competitor's earnings. It was triggered by a city planning board in Vineland, New Jersey.
It's just the perfect illustration of why cloud computing isn't just, invisible magic happening in the ether.
Right, the cloud is a building.
It's brutally physical. NBIS relies on deploying these massive high-density AI clusters to actually recognize the revenue from these hyperscaler contracts. And those clusters require unprecedented amounts of electricity and these highly specialized liquid cooling systems.
Which communities don't always want next door.
Exactly. The August 6th drop occurred because a public town hall in Vineland devolved into this highly contentious debate over a proposed NBIS data center expansion.
It's crazy. It's like winning a contract to supply the entire water system for a major metropolis, but realizing mid-contract you have to build the reservoir and lay the pipes through densely populated suburbs and pay out of your own pocket before a single drop of water flows.
That's a really good analogy.
And the community in Vineland, they aren't looking at a $44 billion backlog on a spreadsheet. They're looking at the realities of heavy industry moving into their literal backyard. They're pushing back on the massive water usage required for the cooling towers, the constant low-frequency noise pollution from the HVAC systems, the strain on the local power grid.
Yeah, the noise is a huge issue for these high-density clusters.
It's deafening. And because of all those community concerns, the city planning board just refused to issue a decision. They effectively halted the entire project.
And this is exactly why execution risk is so incredibly difficult to model for these AI stocks. I mean, you can secure the NVIDIA chips, you can sign the Microsoft contracts, you can model a $9 billion ARR.
But none of it matters if you can't plug it in.
Exactly. If a local zoning board denies your permits because the decibel level of your cooling fans exceeds municipal codes, that revenue gets permanently delayed. The market dumped the stock on August 6th because the Vineland situation proved that NBIS's timeline for deploying this infrastructure is largely at the mercy of local municipalities.
So what does this all mean for the listener tracking this, specifically regarding the Q2 2026 earnings report, which actually drops tomorrow, August 13th?
It's going to be a huge day.
Massive. We have a stock caught between a huge hyperscaler backlog and crushing physical and financial bottlenecks. And the options market is currently pricing in a massive 11.33% implied move on this print.
The volatility crush is going to be intense, for sure.
So what are the specific metrics that will dictate whether NBIS reclaims that momentum or just spirals lower?
Well, from a purely technical perspective, the bulls really need to see the stock reclaim the 50-day moving average at 226 on heavy volume.
Right.
If it rejects there again, the technical setup becomes incredibly bearish. But fundamentally, this entire earnings call really hinges on two specific things: margin trajectory and funding clarity.
Okay, let's start with the margins, because management already warned the street that Q2 margins would likely decline due to the front-loaded costs of this infrastructure build-out.
Right, so the market has already priced in a messy Q2 EBITDA number. That's known.
So what's unknown?
What the market has not priced in is any delay in the second half recovery. Management promised that as these data centers actually come online in Q3 and Q4.
And then the second catalyst is obviously the $25 billion CapEx funding gap. Management has, floated the idea of using asset-backed structures, maybe some corporate debt, and customer prepayments to avoid a massive equity raise. But floating the idea isn't going to satisfy a market with 24% short interest.
Exactly. They need to announce a finalized, locked-in financing syndicate.
It needs to be ink on paper.
Yes.
Yeah.
If they can come out and detail exactly how they are utilizing asset-backed structures, like perhaps securitizing the actual NVIDIA GPUs within the data centers to secure the debt, and if they can announce that Microsoft or Meta are providing significant cash prepayments to fund the build-out, then the dilution fear completely vanishes.
And if that dilution fear vanishes, with 61 million shares sold short, we are looking at the mechanics for a very violent short squeeze.
Oh, absolutely. If the debt is secured without touching the equity, those shorts have to cover, and they have to cover rapidly.
But the downside risk is equally severe.
Right. Oh, yeah. If they give vague answers about ongoing negotiations with lenders, or if they even hint that they might utilize their at-the-market equity offering facility, the stock is going to get punished.
Because when you are trading at an 82% premium to Morningstar's fair value estimate, any indication that the existing shareholders are going to have to foot the bill for this $25 billion expansion will just drive heavy institutional selling.
It's guaranteed. Which perfectly explains why the consensus analyst rating currently sits dead center at a 5, or neutral.
Yeah.
It is a totally binary event. The upside is a short squeeze fueled by secured financing and accelerating margins, and the downside is a dilution spiral exacerbated by local zoning delays and intense capex burn.
So it's a textbook wait-and-see scenario for investors.
Completely. Taking a directional position right now requires a level of conviction in their Treasury Department's ability to structure exotic debt facilities that, frankly, most retail investors simply don't have visibility into.
You'd just be guessing.
Basically, yeah.
So to bring this all together, NBIS Group really represents the bleeding edge of the AI infrastructure trade right now. I mean, you have 684% revenue growth, a staggering $44 billion backlog from the most important companies in the sector, and direct investment from NVIDIA.
It sounds perfect on paper.
It does. Yet they are burning cash facing a $25 billion CapEx hurdle heavily shorted by legends like Michael Burry and getting stalled by local planning boards in New Jersey over noise and water complaints. It is truly a masterclass in the difference between contracted revenue and physical execution.
It really is. And this raises an important question for you, the listener, to consider as you watch these earnings roll out tomorrow. We are hyper-focused on the financial mechanics of NBIS today. But zoom out for a moment.
Yeah, look at the macro picture.
Right. If a company backed by the absolute titans of the tech industry, holding tens of billions in guaranteed contracts, still struggles this mightily with execution risk, community pushback, and capital constraints, what does that tell us about the structural limits of the global AI boom?
That's a great point.
I mean, the demand for compute might be infinite, but the supply of electricity, water, and capital is not.
That is the ultimate bottleneck, isn't it? The software is ready to scale globally, but the hardware still requires local permits, local water, and massive, massive amounts of debt.
Exactly.
Keep a close eye on the tape tomorrow. If NBIS provides funding clarity and proves their margin recovery is intact, this could literally be the launchpad. But if the physical realities of the build-out continue to erode their balance sheet, this 35% correction might just be the beginning. Thank you for joining us on this deep dive, and we will be watching the Q2 results right alongside you.